G'day and welcome to the Grow a Small Business Podcast. I'm your host, Troy Truen. Each week, we speak with an owner who has grown a business with 5 to 30 team members to something bigger. Diving into their numbers and unearthing the pain they've experienced, we explore what they did to overcome each barrier and what they would do differently from day one. Let's get into it.
Welcome, everyone. Today I'm interviewing Nathan McGrath, who is Head of Accounting and Tax at Collins SBA, based in Hobart, Australia. And today we're going to be discussing the importance of business structures and the implications for tax. So thanks for your time, Nathan.
Yeah, not a problem at all. Thanks for having me.
Well, how we know each other, we've been working together at Collins SBA for now 6 years. So time flies having fun, right?
100%. So I moved down here in the middle of winter. It was quite the event.
Yes. So for those that aren't aware, so I work at Collins SBA as a business coach, and as I said, Nathan heads up our accounting and tax division and does a magnificent job. So now tell us, our audience, a bit about yourself and your experience on this topic.
Yeah, so look, I've been an accountant or in the accounting industry for 20 years. It's always been what's the common term is public practice. So always dealing with the small to medium business owners. Various locations. I studied out in Canberra. That's where I finished my uni degree from Canberra, moved to country Victoria, where eventually I bought into an accounting firm, and then from Victoria moved down to Hobart. So I guess my interest and my intrigue behind it is actually being able to understand what the business owners are trying to achieve, and providing them with some good advice on how they can achieve it.
Yeah, and for the benefit of disclosure, as you know, I used to be an accounting and tax practitioner. So certainly I get that, and I think unfortunately too many accountants are too focused on just the tax without understanding the business owner's goals and objectives, which can then provide appropriate context for tax and the business structures. So I guess in the context then of business structures and I guess the tax implications, maybe just talk to sort of some of the key implications of why and that is so important.
Yeah, so I think whenever you're talking about any business structure, you need to get an understanding of who the lawyer is for the client, and if there's not one in there, there probably should be, and having a conversation with that lawyer just to make sure that whatever structure is created, it's conforming to the plans and wishes of the client and the great implications. Fundamentally, there's a couple of things that I look at when advising clients on the tax implications of structures. And the first one, which is probably pretty key, it's about where the cash is going. So with a lot of businesses, they're reinvesting the profits, they're building up working capital, they're utilizing the cash within the business rather than pulling it out themselves, especially early on. And so it's really, really difficult for some business owners to be having this personal tax liability arise when they're not physically seeing the money themselves. So to get an understanding of what the heartbeat is of the business can definitely give you a lead indicator about what structure should be in place. Other aspects that are pretty important are asset protection. So, looking at separating the personal assets and wealth creation away from the business assets and wealth creation, so that if one goes wrong, it doesn't necessarily impact on the other. And the third matter is, what level of flexibility do they want or need? Do they want to be able to give money to other family members as a success of the business, or do they want to be able to just hold on to the money themselves? So all of those have got a fairly significant impact on what type of structure is right for the person, but it needs to line up with their goals. And probably the more uncomfortable conversation to have is, what does an exit plan look like? So most people are setting up a structure or are going into business with the short-term view of, going into business, generating a profit or a lifestyle. But what does the exit plan look like? Because different structures have different tax implications, and sometimes setting the wrong structure up can have a very significant consequence on the way out. So I believe that's probably most of the things that I consider. And the process is actually asking lots and lots of questions to the clients or to the business owners, just so that you get an understanding of what their goals are. If I'm not asking questions, I'm not doing my job. And if I'm asking questions that they haven't thought about the answers for, it might make them a little bit uncomfortable. But it means that I'm also going to be able to provide them with a better solution for taxation purposes than if I didn't ask a question and I just made an assumption.
Yeah, good one. I think, having and being involved with many businesses over many years and seeing business structures that basically have been set up for the wrong reason, sometimes even just for the best interests of the accountants. I've seen a number of times all these structures that you look at it, and one, the business owner doesn't understand it, and two, it boils down to it's just a revenue generation for the accountant sometimes, and it frustrates the shit out of me. Because it's not actually in the best interest of the client. So I think your approach and understanding the holistic situation of a client and their business and their personal circumstances is so important. So you can make sure you sort of customise the structure accordingly. And I think having them at least understand at some level the reasons for the structure is important. And I know you go through that. I mean, they might forget about it, a couple of weeks down the track, but at least you've had the conversation.
Yeah.
So, for our listeners who've got businesses, if they haven't had that conversation with their accountant, that's what they should be doing. And I suggest next time they talk to their accountant, just take the time to understand why they've got their structure in place. And there is some reasons around it, like you were saying. As far as I guess the business structures go, then that obviously impacts on ultimately the tax implications. And as we know, and you more than me, the tax department always introducing new approaches, new rulings, and there's always it's a moving feast, right? So I guess that's where yourself and other good tax accountants come into play to make sure that clients are aware of it. So what tends to be your approach in that context? So we get the right structure set up, then obviously on an annual basis there's payment of tax. So what sort of your approach in sort of helping clients manage that, and I guess importantly be ahead of the game as to what they anticipate the tax is going to be looking like?
No, 100%, and it is definitely worthwhile to note that regardless of the best structure at the time of creation, the ATO has and will continue to modify the rules or the different interpretations, which can have an impact on the structure that's been set up. Look, I see my role as an accountant as primarily a communicator. So the worst communication I have is, I wish you told me that you're going to do this. I'd much prefer to have communication along the lines of, this is what I'm thinking about doing. And so you can work through the scenarios with the person. I'm a pretty big advocate of having a look under the bonnet for the company or the trust or the business structure, before the end of the financial year to give some guidance as to what the tax outcome for the group is going to look like, and allow them enough time, them being the business owner, enough time to either save up for the tax bill that they've got, or make investments within the business, understanding that those investments are going to impact on the tax outcome. I'll pick up on the tax outcome as a result of those decisions that they make. That's a pretty big. The goal for this is actually having the right people in the right room at the right time. And when we're talking about business and small business, we're actually talking about individuals and families more so than unrelated shareholders. So the key part is understanding what the family goals are and what the family needs are to be able to then wrap that into what the tax consequence will be as a result of those decisions.
Find it hard to define a clear strategy, then communicate it and execute it alongside the rest of your team? Or you currently don't work a simple quarterly strategic plan to boost your team's performance? Our Business Growth Formula online course is perfect for small business owners with 5 to 30 team members wanting to grow. We share the mindsets, habits and tools to be a legendary leader in your business. growasmallbusiness.com.
Yeah, that's a very good point. And again, like you say, typically with family-owned businesses, that becomes even more important. And I think it's interesting you sort of see yourself as a communicator, which is great, by the way, because I don't reckon many accountants would see that. And I think it's so important. So many times over the years, come across business owners where they change accounts because they haven't been communicated well, and they get blindsided by tax payments and what's required.
Yes, yeah.
So I guess that sort of comes back to that planning aspect, is fair to say?
It is. And for most tax outcomes, there's at least 3 to 6 months lead time, between when the tax liability will fall due, as opposed to when the transactions have occurred. It can be up to 12 months if you think about it and put some parameters in place. So really, there's no reason why the business owner shouldn't be informed about where they're standing for taxation purposes. And there's no reason why the business owner shouldn't be able to communicate with people that they trust with the right professional knowledge, be able to make investment decisions within that business that will help them both short-term and long-term, both for their profitability and also their cash flow as well. And those two are significantly different with results of the tax outcomes.
Yeah, no, very good. I think you mentioned earlier about structures are important for asset protection. I think that's often overlooked with purely a focus on tax. So maybe just sort of give our listeners a bit of an insight into what that looks like as far as structures from an asset protection perspective.
So this is important to work with your lawyer or the business owner's lawyer as well. The separation between business owners' personal assets and their business investment, and most of the time that will involve having a company. But then there's decisions about who owns the shares in the company, who the key people in the company are, who's the director, who's calling the shots, who's making the decisions, so on and so forth. So the most effective structures are where the lawyers are also providing their guidance with asset protection. But the structures that need the most care and attention are the ones that people have really they've outgrown, the business was more successful than what they've got, than what they first had, or they start employing people, they start taking on more risk. All of those type of matters tend to change, where you need to draw the line in the sand between what personal assets have been put at risk, as opposed to, what the business should be able to manage itself.
Yeah, and you make a good point about, I think, business structures when, business owners start a business, but a lot of the time it's just set in stone, where it probably should be a regularly reviewed exercise as they grow and the business changes. Is that sort of your approach?
Yeah, it is. And I guess you also need to determine what's the, once-off transaction, or the once-off year, as opposed to, is there a level of continual improvement with the profitability. So I tend to pay less attention to, a once-off year with a structure, and I tend to look at the underlying trends of the business, and understanding that there are a lot of concessions available for small businesses to be able to change their structure to something that's more suitable for them. Even though that they're available, the best option is to get the structure right in the first place, which is having the right communication at the start. But there are definitely concessions available to be able to move and change the business structure around as the businesses grow or as they change as a result. But that's where you need to have those conversations with a trusted professional for you.
Yeah, no, good one. I think, have you got some sort of stories that you can mention to our listeners that sort of elaborate a bit further on some of these points?
Yeah, so we've had I've had a client fairly recently where they had a business which was going very, very well. And the conversation that I had right at the start was, well, are you going to just control this business yourself, or do you want to share it? And their intentions changed. So the customer had their affairs in a company, but the company only had one share in that company. So we had to come up with legitimate ways as to having more shares in the company there, so that it could split, so that 10% of the shares could be owned by one business owner, and the other 90% remain with the existing owner. So those type of events are quite important. We've had a lot of businesses in the last 4 or 5 years that have gone really, really well under a trust structure, to the extent that the individuals or the beneficiaries of those trusts are paying a huge amount of tax without seeing the cash flow as a result. And the reason is that the profits are being reinvested within the business. So we've had conversations with those people about, is the trust going to be the best structure for you moving forward, or are you better off to invest this in a company where I use the term a handbrake, where the company pays the tax rather than all the profits flow out to the individuals, and it can be a decision made by the directors of the company to pay a dividend out when it's appropriate to, not this default arrangement where the individuals just pay the tax, whether they've received the cash or not.
Yeah, I think you you mentioned trusts there. So some of our listeners may not be aware what a trust is compared to a company. So as simply as possible, how would you describe a trust for our listeners that sort of don't understand them?
Yeah. So a trust is a structure that's designed to allow flexibility in accordance with its rule book. Okay, the rule book is the deed, which is drawn up by a lawyer, and it allows a trust to do certain things. So the trust can go into business, the trust can borrow, the trust can push its income across through to other to other beneficiaries, or which is generally the family group. So without going into the old English case law or common law. Like a trust is a vehicle that accountants use probably more so as investment vehicles to hold shares in companies rather than as a business operation. But a trust allows flexibility to distribute income either to different families with their groups or within the one family itself, depending on what the desired outcome is there for the business owner.
Yeah, and suffice to say, the ATO and sometimes governments from time to time look at sort of shutting down the benefits of trusts, and there's always a focus. And I know recent times around professional services businesses, insofar as what you can do. So certainly they can provide flexibility. And I think, coming back to your point before about asset protection, they tend to be a good asset protection vehicle as well,
Yes,
which tends to be maybe a bigger driver than tax sometimes. So
yes, and not every trust is set up for accounting purposes in mind. There's numerous different types of trusts, such as like a special disability trust, where there's no intent of distribution to ineligible beneficiaries and things like that. So not every trust is set up just for an accounting or a business purpose.
Yeah, no, it's a good point. So I think taxes not necessarily are the easiest thing to talk about, and I think my takeaway from this conversation is really it's all about communication and making sure that business owners aren't blindsided with respect to the tax implications of running their business. And I guess you've given some good insights into your approach, Collins SBA approach, which is proactive. It's all about being ahead of the game and not looking in the rear vision mirror as best as possible. So just winding up, Nath, what's at least one thing you'd recommend a small business owner does based on your knowledge and expertise?
Mine would be ask lots of questions to the professionals that you're surrounded by. The more questions you ask, the better insight you're going to have. But then the trick is also to make sure that they're listening to what questions you're asking, and that they don't have a premeditated conclusion about what you need, which isn't necessarily what you desire.
Yes, good point. So again, making sure the structure suits is fit for purpose as far as the client and their circumstances. So thanks for the chat, Nath, and some great insights. And I guess if anyone wants to reach out and talk about their business structures, then they can contact you at Collins SBA.
Yeah, not a problem. Thank you.
And for our audience, we would greatly appreciate a review in iTunes or whatever platform you listen to us on. More reviews means we bubble up higher in iTunes, etc. So more business owners looking for podcast help with their growth will find us.